courage to get you outside of the box. It takes courage to be successful. It takes courage to win. People don't talk about people that don't win. If you win, they're going to talk about you. Do you have the courage?
What's up, everyone? We are back with yet another exciting Ripple XRP update, and today we have a lot of things to cover in this video. To start with, for a while now, we've addressed the general structure of the market. Bitcoin has moved up a few percentages, and now everyone is bullish on Bitcoin. Well, this makes me wonder where all these people have been. We have been bullish for the longest time now, even with the highs and lows of the market. But before we get to that, let's see what's actually happening with XRP. The truth is, since the year started, XRP has been one of the significant assets that people have seemed to have forgotten about. They almost feel like nothing significant is going to happen now, that we aren't getting any solid response from the SEC. I bet most people probably don't even expect the asset to pump at all, not until 2023. But what if I told you that's not the case? We could possibly see a 1,500% run. Welcome back to MoneySide, your favorite crypto news channel. If you're new here, welcome to the XRP team. Hit that subscribe button and be sure to turn on notifications so you don't miss out on our daily crypto news updates. To get a clearer picture of what's happening, we need to compare and contrast the market structure that we've seen in the past. Starting us off is a tweet from Credible Crypto, and it says, "Mid-cycle corrections are designed to shake you out. And they're quite effective. Just ask the guy who sold Bitcoin under $10,000 during the March capitulation event before Bitcoin ran 1,500%. Patience. HTF structure remains intact. It's really quite simple. If we look at where we are right now in this market cycle, we can foresee Bitcoin potentially hitting the $120,000 to $160,000 mark. Well, most people might say that Bitcoin is a dead coin and no one needs it at this point. But the truth is, if we want to run the XRP numbers up, we need some movement in Bitcoin as well. Moving forward, we have this exciting tweet from Bramwell Fox on Twitter. He shared a comprehensive chart that shows his speculation on how the market will move using the XRP Bitcoin pair. According to him, XRP will move up. While that might not happen in the next hour or even in the next couple of days, there are some fractal similarities that dictate that it could happen within a shorter number of 3D candles ahead. Bramwell Fox said in one of his replies on Twitter, "I have two macro theses. One of these is that technology follows evolutionary cycles, and I truly believe that Bitcoin has run its days as a network of innovation, and that blockchain will continue to evolve with new software built atop. Thus, I do see a declining intrinsic value over time." It does not mean Bitcoin goes to zero. It just means the same for Bitcoin as the Yahoo search engine once Google came around. Because of this, plus general political agendas, I see other technologies gaining relative to Satoshis. And if we assume those 2 points have any merit, then we ask ourselves if we have any technical merit to show a pattern that repeats or improves on a previous pattern. And that's where the technical 2017 XRP/Bitcoin fractal comes into play. See, the DXY soaring is throwing off the USD pairing values. Many charted the 2017 XRP-USD pairing without factoring in inflation and the DXY value, which is why I believe the Bitcoin explosion is more important to chart. If Bitcoin loses value, XRP will rise in value against Bitcoin. Knowing that Bitcoin has been moving side by side with stocks, the dollar will have to lose value for XRP to rise in dollar value. That's a bad scenario. Wish there was a chart at XRP/gold. And add to that, DXY is facing major historical supply regions as we speak, with equities facing both seasonal and primary trend exhaustion. The peculiar scenario is that we are facing inflationary peak pressure with the dollar on its foreseeable last days as a global reserve currency, a much larger centennial trend peak, which makes blockchain or crypto a possible hedge during equities collapse, which we haven't experienced before. The last major bear market, we didn't have blockchain. Thus, aspects of this crash are going to be different. So it's a unique capital flow issue unless we assume all capital will flow into bonds. Doubtful. And with more retail, global investors who have access to capital markets, it appears legacy capital markets could face a downturn, with crypto markets playing out non-identical. For XRP holders, the journey begins once again once we break this level. The end-of-cycle target for this market will be around the $10 to $15 at the higher fib levels. Away from that, we have a couple of news bits from around the banks. If we look at a tweet from Gold Telegraph, we can see a story that's not being talked about enough is how the Swiss government quietly proposed a public liquidity backstop for the big banks. If one of them failed, the question is, why now? From what's happening here, we can already tell that a financial crisis is going to happen, and soon. They are just trying to warn us about it ahead of time. All you need to know is that these things take time, and while it may not happen now, doesn't mean that it won't happen eventually. Now, as we start to wind down on today's video, we've got an exciting tweet from Ripple, and it shares Ripple Liquidity Hub will unlock new avenues for businesses and financial institutions to remove barriers to crypto access, build new revenue lines, and free up working capital. Ultimately, Liquidity Hub paves the path to a crypto-first future for business, helping traditional banks, neobanks, fintech, and financial providers around the world, even the infrastructure providers that support them, to quickly and confidentially ramp up a crypto offering and cross the finish line ahead of the competition. Now we're going to be talking about building a professional trading mindset. Now, while this topic has been at the subject of countless books and trading literature over the years, we thought it would be cool to break down a few of the most important takeaways for the money side community. All right, let's jump in. 1. Start thinking in probabilities. Let's take a quick look at one of the most important concepts in trading and in life: expected value. Expected value is simply a number which indicates, based on probabilities, the value of executing a certain action. It can be positive or negative. Will this trade make money? Should I change careers? Should I marry my partner? It all comes down to expected value. Now, what makes up expected value? Two things: bat rate percent and win-loss. Bat rate is the percentage of wins versus total outcomes. Win-loss is the size of the average winner divided by the size of the average loser. In other words, what is the chance this works? How big is a win? How big is a loss? When you combine these numbers, you can much more clearly understand whether or not it makes sense to take a certain action. Let's say, for example, that a certain trade idea has a 50% chance of working. A win earns you $2, while a loss, you lose $1. Should you take the trade? Let's find out. In this example, you take this trade 100 times. 50 times, you win $2, and 50 times, you lose $1. You'd end up with a total profit of $50. 50 times 2 minus 50 times 1. Clearly, this trade has positive expected value. So even if you take the trade and end up with a loss, you still made the right decision from an EV standpoint. The tricky business with expected value, EV, is that bat rate and win-loss aren't hard numbers. They are estimates. Thus, building a feel for the likelihood of something happening and building an understanding of the amplitude of wins and losses is a key skill to build for trading and life. An easy way to better calibrate your antenna for this is simply making a note of what you expect to happen in your trading journal. Over lots of repetitions, your ability to guess outcomes should improve. 2. Self-awareness. In trading, actions of all market participants at all times are driven by two fears: the fear of missing out and the fear of loss. In other words, fear and greed. The thing is, depending on your brain chemistry and life experience, it's likely that one of these fears impacts you more strongly than the other. Think of the following scenario. You put on a trade and the position begins moving in your direction. The asset then begins trading sideways. Let's examine two ways this could go. A, you close your position. Then the asset begins ripping in your direction once more, tripling in price. You've missed this extra move now that you've taken your position off for a small gain. B, you don't take the position off and the asset round trips back down to your stop loss and you take an L on the trade. Which of these scenarios is more painful to you? There's no right or wrong answer, but it's important to know which fear has a stronger hold on the decision-making complex in your brain. If you find that you're more prone to FOMO, then try to figure out a strategy where you can squeeze every last drop of a winning trade. If you're more prone to the fear of losing, then try to figure out a strategy where the possibility of taking big or consistent losses is much less likely. 3. Strategy fit is extremely important. This tip piggybacks off the last tip about self-awareness and really underscores the importance of consistency in interacting with the markets. When you interact with the markets, having a written out, well-understood trading plan is key to success. The biggest and most elite hedge funds in the world have clearly defined investment mandates, best practices, and business plans. What makes you think you don't need a plan? That said, not all trading plans are created equal, and even the best laid plans of mice and men, well, you know the rest. When designing a trading plan, many new or intermediate traders focus solely on the money-making aspect, as in, which strategy is going to earn me the highest amount of profit over a given period of time? How can I gain some edge? Typically, back tests, fundamental research, vision, and more play a part in helping define the criteria for a profitable strategy. However, expert traders know that there's something even more important than defining your edge: ensuring consistency. For example, let's say that you come up with a perfect trading strategy that should, in theory, in the future, allow you to trade extremely efficiently. The plan lays out a perfect set of criteria for buying market bottoms and selling market tops. For newbies, this is the holy grail. However, just because you understand a strategy doesn't mean that you will be able to execute that strategy. You could test this perfect strategy in real life, and if you're unable to execute the set of rules you've laid out for yourself in the heat of the moment due to your psychological makeup, then it doesn't matter how much edge the strategy has. You can't execute. Thus, finding a strategy that you can will yourself to execute with consistency no matter what is happening in the markets is of paramount importance. In terms of expected value, EV, and self-awareness, having a strategy that's 30% efficient but you can execute with 100% certainty is much more valuable than a strategy that's 70% efficient but that you can only execute accurately about 40% of the time. Not being stressed from a loss is the real flex. Design around preventing mistakes, not losses. As always, do your own research and always trade safely, guys. And we continue to pray and support the people of Ukraine. Please keep in mind we're not a licensed financial advisor. All videos on this channel are intended for entertainment purposes only. Tell us what you think in the comment section below and let's have a conversation. Thanks as always for watching. Don't forget to like this video and please click on that subscribe button below. And be sure to turn on notifications. That way you get a prompt whenever we drop our amazing content. Thanks again, and we'll look forward to seeing you on the next Money Side.